Did you know that 70% of wealth is lost by the second generation and 90% by the third? Are your kids ready to handle the wealth that you've worked a lifetime to build? In this episode of the Unlock Your Business podcast, we discuss tips and traps in preparing the next generation for the great wealth transfer. Hi, you're listening to the Unlock Your Business podcast, where we discuss ways you can unlock your personal and business wealth with financial, investment, and business strategies. I'm Rafi Pelagian. I'm a financial advisor and run financial services businesses that aim to help individuals, families, and small to medium business executives manage, grow, and protect their wealth. Through this podcast, I share my experience and knowledge from a financial advisor and business owner's perspective, in addition to my wins and struggles. So if you want an authentic and honest discussion on personal and business growth, investment, management, and unlocking wealth creation strategies, you've come to the right place. The Unlock Your Business podcast is brought to you by financial advice firm Manly Financial Services. Please see the website links in the show notes. We hope you enjoy the discussion. Welcome to the Unlock Your Business podcast. I'm Rafi Pelagian from Manly Financial Services, and today we're going to talk about ensuring that intergenerational wealth lasts many more generations. Australia, as we've all heard, is entering one of the largest wealth transfers in history. Trillions are sent to pass from baby boomers to Gen X and millennials over the next 20 years. The challenge here is that wealth can be lost within 1 or 2 generations if families don't prepare. In today's episode, we will discuss key steps that families can take to prepare their children, their beneficiaries, and protect their legacy that they're passing on. Now, why does this all matter? You've all heard the 3-generation rule. Wealth built in 1 generation is often gone by the 3rd generation. Common issues that we see are lack of financial knowledge and literacy in beneficiaries. We see a lot of family conflict around inheritances when there isn't a lot of communication, and poor estate planning and tax structuring as well. We see many instances where new clients come to us with horror stories. In many cases, they involve a lack of communication, some power struggles within the family, and tax implications. One particular instance didn't actually include a conflict, but it was more around the lack of structuring. So the parents hadn't stipulated in their will to set up a testamentary trust. Effectively, a testamentary trust is a trust that is basically enacted at the time of the passing of the surviving partner. So you've got partner 1, partner 2, partner 1 passes it to partner 2. When partner 2 passes, the testamentary trust is set up. Assets going into the testamentary trust allow the beneficiaries a bit more flexibility in terms of managing those assets. What are they going to sell? What are they going to keep? How do they manage them going forward? And obviously protection, which we'll talk about in a second as well. Now, the parents hadn't stipulated that assets should go to a testamentary trust, so we had several properties that were sitting there and basically owned jointly by the 2 beneficiaries. Now, the 2 beneficiaries had different scenarios in terms of income, in terms of the types of businesses they were in, and obviously the risks of potentially being litigated. One person was PAYG, the other one was in their own business. They've also got different families with different family structures, different number of kids. There's a whole lot of differences. So passing the assets to the 2 beneficiaries and having them own them 50-50 was just not going to work. Neither of the 2 siblings could generate enough money to buy 50% off the other, and they basically had to sell the assets so that they could have liquid cash to be able to go ahead and go away and buy other assets. Whereas they preferred, obviously, to have a scenario where they could maintain some of those assets that their parents had purchased and invested in many years ago, not just because they were legacy assets, but also because they were really good assets. There was also issues around a potential marriage breakup amongst the beneficiaries, and that heightened the risk of loss for them because of the fact that the assets weren't owned or structured in the trust. However, there are ways to minimize a lot of these risks that you do see that we've just discussed. The first step is really easy. It's about open communication, conversation. It's important to talk about money, values, and intentions early. Unfortunately, there's not much discussion in schools around money for kids as they're growing up. And at the same time, you're not seeing a lot of families sit down and start talking about how they've built their assets, what lessons they can pass on to their children, even if they're adult children, and also adding some context around some of this legacy that they're passing on so that people don't just view these assets as dollars and cents. People can start conversations with adult children by framing it around goals and values. It's not just money. Some assets is maybe assets that the parents would like the beneficiary to hold on to as long as they could, if it's possible. They can do this by holding family meetings with or without an advisor or an accountant as a facilitator. Obviously, in a lot of cases, we would go in as facilitators in terms of these meetings, but these are family meetings. These meetings shouldn't have external parties in them, not at this point. It should really be about sitting down, talking about these issues, putting the context, the legacy and the emotion around these particular assets and going forward. The other thing we get a lot of our clients to do is to develop what we call a statement of wishes. So a statement of wishes is not a will. The will does the job of saying who gets what and when and all that kind of thing. But the statement of wishes is basically a document that outlines a story, an intention, the importance around an asset. And that could be something that those beneficiaries hold on to and really cherish going forward after the passing of their parents. So communication will reduce uncertainty. It will definitely build alignment across the whole family prior to a death event, and it will avoid any surprises amongst family members, potential beneficiaries, when the untimely death event occurs. Step 2 is around building financial literacy in the next generation. Now, as I said before, there's not a lot of education at the school level or even the high school, primary and high school level around money. There really isn't. So you start to see people, when they leave school, they don't sometimes see the value of money. They don't understand how hard it is to generate and therefore spend it quite early. And they also get themselves into different debt environments because they just don't understand how the importance of having assets over liabilities, the importance of cash flow, all that kind of thing. This is a critical and large part of our engagement as a firm in family groups today, that financial literacy. So children may inherit significant assets, but they just lack the skills to be able to manage them, to be able to view the assets and the money and the cash flows in the right way. So to teach them, we've got a number of strategies. The first is that we'd like to introduce them to budgeting, investing basics, superannuation and taxes, so they really do understand these structures and how to structure yourself in the best possible way. We like them to be involved gradually in family financial discussions. We're sitting down with adult children and the parents and to be able to talk about the different strategies we've got in place for those particular assets that will be passed on to them eventually. And we do also obviously encourage them to have their own engagement with a financial planner, preferably one of our advisors, because again, they're in that process. They've got that mindset. They start learning about things, they start getting educated, and they start experiencing the markets, whether they're property markets, equity markets, the ups and downs. Involving an adult child or adult children in managing an investment property or a family trust is really a great way to start this. For instance, if a family has an investment property, and let's say that they're between tenants and they're going to do a little bit of renovation to the property, involve your kids in that. Involve the adult kids in that. Make them understand the asset, how it's going to work, why are we putting the money in, what was the rental before, what's it going to be now, what was the capital value, is there going to be an uplift in that. Getting them involved in that process or in other assets that potentially are in a family trust is critical and a great way to really boost that financial literacy and get them interested in that topic. Step 3 then is about getting the structures right. And we talked about that in an example I gave about testamentary trusts earlier. We need the tools to protect the wealth. We need wills, a power of attorneys put in place. We need family trusts and testamentary trusts, and obviously self-managed super funds where they are relevant, and there are areas that they are relevant. This ensures that when the assets are passed to the next generation, it's done in the most effective way possible, and avoids the unintended consequences of such as outdated wills, not having power of attorneys, which obviously opens up to challenges of the will, poorly structured assets, and not accounting for blended families. And that's a really important one, where there's got to be certain amounts of assets and wealth that goes to certain kids from maybe a different past marriage or previous marriage, and then the other kids which potentially would be younger from the newer marriage. Really important to sit down, get the structures right, and then ensure that the flow of funds is going to be to your wishes, to the way you want it to happen. One good example in terms of structuring is a scenario where a client of ours, where we've got two beneficiaries. We've got one of their beneficiaries, adult children, has an intellectual disability, and he really can't make good financial decisions. He usually spends money, doesn't see value in it, and really makes bad financial decisions due to his intellectual disability. You've got another one who has a family, who has kids, is a hell of a lot more responsible. Now, this is where the different structures come in, because effectively, when we have assets in superannuation, we can't pass those assets as an income stream, as a pension, to our adult children unless they have an intellectual disability. So in this sort of scenario, instead of saying we've got a super fund and we've got personal assets and we've got family trust assets, let's just cut them in half and give each beneficiary 50-50, what we're able to do is to say, let's give all the super fund assets to the child who has an intellectual disability. That way, an income stream will be paid so that they will only have access to that income and not the capital. They can't just go below the capital on some bad financial decisions. And then the equivalent 50% of the remainder of the wealth can then go to the other beneficiary who has a family and most probably a mortgage, child expenses, education expenses, all sorts of things, and is quite responsible with money. So it's really having a look at all the assets, having a look at the family situation. In some cases, as I said before, could be a blended family. In this case, it's not. But then looking at health scenarios and other scenarios where we want to say, how do we protect that wealth so that we can protect the beneficiary from losing that money, from wasting those funds? We want to ensure that they've got enough wealth for the long term. Step 4 is an important one, and it's about aligning wealth with family values. Wealth transfer, as I said before, it's not just about money, it's about legacy. And in my experience, when we start to link those defined shared values around education for, say, children and grandkids, philanthropy, entrepreneurship, security, when we start to link those shared values with those assets, that's when we're creating a legacy that we can see will last over and over, generation by generation to generation. Some ways that this can be done, again, communication is an important point, but by establishing a family charter, or setting up a philanthropic fund or charity, or via a trust. That could be something that the family sets up together before passing and starts managing that as a family group. And then supporting younger members in terms of when they want to start a business or further education or whatever it may be. So really aligning wealth to those family values. And then step 5 is to use a professional to facilitate. Okay, and this is obviously quite critical. It's why we're in business. Accountants, lawyers, and financial planners must work together in these family groups to ensure tax compliance, to create structures that protect assets. What entity do we want a business in? What entity do we want the assets in? What entity do we want as the service business? That's obviously where the lawyers come in and help. And also to facilitate family meetings from a neutral perspective, because these three facilitators, the accountant, the financial planner, and the lawyer, are coming at it from a different angle. And the angle they're coming at it is from, let's make this wealth last as long as possible, in line with the goals of the senior people in the family who have accumulated those assets, and effectively let's build from there. One particular scenario we've got at the moment that we're working on is a situation where we have significant assets. They're going to be broken up into different trusts for the beneficiaries. And in this particular scenario, because there's going to be separation in terms of the assets and the beneficiaries and the trusts, because everything's going to be done in different bubbles, if you like, or in different entities, it's important to sit down with an accountant. It's important to sit down with a lawyer. So we've effectively engaged an accountant and a lawyer to help our client go through those processes before we even give any advice or any discussions around the investments within within that particular trust, because if we can't get those two elements right, then it's going to degrade the real returns that we're able to generate for our client over the long term. So in terms of summarising and wrapping up, we've got to recap the key steps. And the first one is really to start conversations early. Start that involvement, the conversations, explaining the legacy, the context behind that wealth. Number two, build financial literacy, and communicating and all that's going to help with the financial literacy, but involve them in family meetings, refer them to your financial planner, get them to get interested about money and making money and investing money, securing money, because that's critical. Obviously, a large part of the work that we do in this sort of scenario is about capital preservation, not so much about wealth creation, because a lot of that wealth creation has already occurred. Get the structures right. Now, this is critical for capital preservation, not only in terms of risks of any types of litigation or challenges to the will, but also in terms of how the assets are structured from a tax perspective, making it as seamless and as effective as possible. Align wealth with values. Do we have values of philanthropic activities or different education or funding or whatever it may be throughout that larger family group? Have that discussion. Talk about those structures, establish those structures earlier on and get everyone involved so that the wealth can be aligned to the families of the people who have created that wealth. And lastly, use professional support. Accountants, lawyers, financial planners, in terms of giving that advisory value for the next generation in terms of passing that wealth on. So preparing the next generation isn't just about passing the money. It's not just about wills and powers of attorney. It's about passing on knowledge, passing on values, and a lasting legacy. If your family is thinking about how to prepare for wealth transfer, please reach out so we can discuss ways that we can make the process smooth, tax effective, cost effective, and conflict free. Visit our website at manlyfs.com.au and have a look at our intergenerational wealth transfer page to get more information and how to get in contact. Thanks for listening to the Unlock Your Business podcast. We hope you got some value from listening to this episode that discusses such critical aspects, such important aspects at a really timely moment as we're hearing more and more about the great wealth transfer in the papers and on TV. Please subscribe to our podcast wherever you consume this podcast content, or to our Manly Financial Services YouTube channel, and we'll see you in the next one. Thanks.